So having a look at the rules for those three, zigzags and flats. First up, rules for zigzags. Zigzags subdivide into three waves, which subdivide into 5, 3, 5. Wave B never moves beyond the start of A for a zigzag. Waves A and C both subdivide into a 5-wave impulse or a diagonal, and wave B subdivides into a 3, a triangle, or a combination. Rules for flat corrections. Flats subdivide into 3 waves as well, which subdivide into 3, 3, 5. Wave B always retraces at least 90% of A and can move beyond A. So wave B for a flat correction is usually longer than a B wave in a zigzag. Also, wave C subdivides into a 5-wave impulse or a diagonal. Having a closer look now at those combination corrections, double and triple corrective structures. Double corrective structure in a bull market. Flip it over, here's a double corrective structure in a bear market. In a bull market, price is trending up. We have our first 3-wave structure, ABC labelled W, joined by X in the opposite direction, ABC labelled Y. Likewise, in a bear market, price is moving down. The correction begins with ABC for W, joined by X, ABC for Y. Here's a triple corrective for a bull market and a bear market. Triples are a 3 joined by an X, a second 3 called Y joined by an X, a third 3 called Z, or labelled Z. Triple corrective structures are rare, whereas double corrective structures are much more common. Some basic overriding rules for double and triple combinations. Double combinations can be made up of 2 zigzags, in which case it's called a double zigzag, or we can have a zigzag and a flat and a zigzag, 2 flats, a zigzag and a triangle, or a flat and a triangle. Triple combinations only have 2 types, either 3 zigzags in a row or 3 flats in a row. There's an important distinction between a double and triple zigzag and double and triple 3 combinations. Double and triple zigzags affect a greater retracement in price. They have a greater slope of angle. Whereas double and triple 3s, their main purpose is to extend the market sideways, and they don't affect such a deep retracement. Finally, having a look at this last type of corrective structure, triangles. Triangles can be one of 3 different kinds: contracting, expanding, or barrier triangles. Contracting triangles in bull and bear markets have trend lines on the upper and lower edges that move together, so the triangle is contracting. Expanding triangles, as the name suggests, expand. Trend lines above and below the upper and lower edges of the extreme of the triangle expand or move apart. Barrier triangles have one trend line that's essentially flat, creating like a barrier, hence the name. The main rules for triangles are different for each different type. For a contracting triangle, wave C cannot move beyond the end of A, and E cannot move beyond the end of C. Likewise, D cannot move beyond the end of B. Therefore, the triangle is contracting. Trend lines drawn along the upper and the lower edge must move together. This is a really useful rule because if we know we're in a triangle, we know where price will not go. If we know we're in a C wave of a triangle, we know the limit, in this case for a bull market, of downwards movement. And we know the trend will move and change in the opposite direction about a certain accurate point. This is where Elliott wave can be uncannily accurate. The direction of the market entering the triangle in a bull market is up, is always the same as the direction the market exits the triangle. This is really important when you're expecting what's going to happen when the triangle is over. The main trend direction will resume. Likewise, for a bear market, the direction entering the triangle and exiting the triangle are the same. In the rules for expanding triangles, C has to move beyond the end of A, must reach a new price extreme. Likewise, D must move beyond the end of B, and E must move beyond the end of C. The result is the trend lines on the upper and lower edge of the triangle move apart or expand. This is useful, therefore, if we know we're in a triangle, we know at least, if we know we're in wave C, for example, we know where the price must go. It must go at least to the point that was reached for A. A barrier triangle has one trend line, and it's always the BD trend line that is essentially flat. The height for a bull market of B and D is essentially at about the same point. For a bear market, it's the lower edge of the triangle, the BD line, where B and D are essentially at the same point. Otherwise, the rules for barrier triangles and contracting triangles, they're quite similar. The rules are reasonably similar. Finally, a quick summary of rules for triangles. Triangles always subdivide into 5 waves, A, B, C, D, E. At least 4 of those 5 waves subdivide into a zigzag or a zigzag combination. That's why the diagrams show each wave A, B, C, D, E broken down into 3. A triangle never has more than one complex subwave. It usually has one complex subwave, and that's usually C or D. Contracting triangles, C never moves beyond A, D never moves beyond B, and E never moves beyond C. If this rule is violated, the triangle is invalid. Likewise, for expanding, as explained previously on the diagram, C always moves beyond A, D always moves beyond B, and E always moves beyond C. And finally, barrier triangles are similar to contracting, except waves B and D end at about the same level. And that concludes our Part 3 video for corrective wave structures.